Welcome, world, to yet another episode of Manage Your Damn Money with Ben and Malcolm, the place where we trade in personal finance advice for entertaining conversations about money. Malcolm, it's another week. What's going on with you? How are you feeling?
Feeling good, man. I, as you know, finished my race this past weekend.
Your race.
And I'm surprised that I'm walking as well as I am already.
Indeed, you did finish. Tell us about this marathon that you ran, your time, everything. Give us the rundown.
So I can level with you now and let you know that I did a half marathon.
Oh, whatever do you mean you did a half marathon?
13.1, even though you were expecting me to do the full 26.
You came on
and
here
what?
on sanctified holy ground of our show, and you said you were going to run a marathon.
No.
And you ran what?
I told you I was going to run a race, and you told me I couldn't run a marathon.
What?
So, anyway, not the full 26.2 because I'm not crazy. I ran 13.1.
You know what I really should have done? I should have.
But I let you continue to think that I was running the marathon so that I could use your haterness as motivation to get it done. That is a fact.
You use my hatering to power your dreams. It's like self-esteem, like Kanye said.
Absolutely.
That's an interesting
because I need a villain to fight against at all times, and you happen to be that villain for me in this case.
Listen,
so I appreciate you.
My hating is reserved specifically for bringing people down, not lifting people up. So the fact that you used my hating for your success, I resent that, sir.
I appreciate it nonetheless.
I resent that, sir. Well, of course, this is Manage Your Damn Money with Ben and Malcolm, and in this episode, we're talking about the history of taxes in America and abroad. There's been a lot of discussion about taxes in the news, so we thought it might make sense to kind of review some of how taxes came to be. And talk a little bit about what's going on with taxes in the United States now. But before we get to that, it is time for headlines. This week's story for our headlines on Manage Your Damn Money: how to do your taxes if you have a side gig. Now, Malcolm, it's the end of the year. This is normally about the time I start dreading because I know that I have to start getting my receipts together. I have to start getting everything that I ever spent money on as it pertains to any kind of business related items together so that I can do the whole tax thing. And I've been doing it on my own for the last several years. So it's all, along with TurboTax.
Right.
So it's an interesting, time because it's something that I always want to procrastinate on. But real quick, like I said, the story we pulled, the headline read, how do you do your taxes if you have a side gig? As the end of the year draws near, our friends at The Motley Fool published a November 2017 article by Wendy Connick, which explores how to deal with income from a side gig on your taxes. Side gigs are great, but extra income as a 1099 consultant can make things a little bit more hectic come tax time. Anyone with a self-employed income is required to fill out a Schedule C when preparing a federal tax return. If you have $5,000 or less of business-related expenses to report, you can use the Schedule C EZ instead, which I imagine is an easier version of that. And then also a side hustle resulting in a loss for the year requires you to use the Schedule C rather than Schedule C EZ. And if you consulted for a company, they'll send you what's called a Form 1099 MISC reporting the amount of income you were paid. This corresponds directly to the 1099 form you fill out when you start for that consulting work. Usually you put your social security number on there or your business's LLC or tax identification number. And then also if you have multiple clients or customers, you'll need to add up all your 1099 MISC figures and other sales figures for the year in order to calculate your total gross of receipts. So how much did you make in total side income altogether? And then the total cost of goods sold is then subtracted from the gross receipts to determine the gross income from your side job. This is the number you owe on taxes. There's a specific bit about expenses. Expenses are actually, they're not, what they are not is what are some ridiculous business expenses that people try to pass off as?
Like family vacations.
That's the number one.
I've heard and seen that one. Believe it or not, things like country club
fees
okay. or memberships are not allowable. I've actually once heard somebody trying to write off their kid's school tuition.
That is not a business expense.
So, people will try.
Right.
So I'm glad that you did actually pull all of those different pieces of what is and what isn't.
Right.
From sounded like the IRS reading it up here.
Absolutely.
But, people get creative.
Yeah. So business expenses primarily are things that expenses you incur during the course of doing business. That can be anything from like driving your car to buying lunch for the day. That could be a business expense. But any business-related expenses can reduce your tax responsibility overall. You have to keep proof of said expenses for at least 5 years. So create some kind of filing system, either in your email account. I probably would, not do the whole paper filing system because that's just cumbersome. One thing that I do is I just take a picture and PDF image of each receipt that I need to account for, and then I put it in a particular folder in my email, and then it's just there. And as that 5-year mark comes up, I can get rid of like the folder from 5 years ago.
You could just scan it and like save it on an external hard drive.
Yeah, I mean, or I could just save it on Google servers.
Because like not every receipt is electronic, and I know you said you take a picture of the receipt and all that, but there's another option, like just actually saving it in a folder on your computer and not in your email server.
That's true. So there's a lot of different ways.
I'm worried about the data. I'm always worried about the data being able to.
Because Google's about to sell me back what I bought in terms of receipts. And then also paying quarterly estimated taxes. This is kind of a big deal. Technically, you're supposed to pay your side gig income tax quarterly throughout the year. However, you can also decide to pay it in April at tax time. But you have to save enough money, obviously, to do that. The whole quarterly tax thing works like you use what you made inside gig income the year prior. And even if you have like a regular business, it's the same kind of principle. Whatever you made prior, you use that to pay your taxes the year you're in. And you pay that quarterly, and there's like a website and a portal that you can use to actually pay the government straight away.
That's probably the toughest part.
Yeah, I mean, I've actually done that before as a full-time, self-employed person. And it was when I did not pay quarterly. And when I paid in April, it hurt.
A lot of times if you have a side gig, you need that side gig income.
Right.
So to then have to save, let's say 25% of it to be able to pay the IRS, it's like, well, the reason I'm doing this consultancy or whatever I'm doing on the side is because I needed the cash today. So it is very tough to remain disciplined in tax estimates and actually filing quarterly.
And discipline is the biggest thing, because you could be sitting there like, well, I know I got to save this, but I'll get that later. I need these new shoes. I need this PlayStation.
I'm not even worried about shoes and a PlayStation. I just mean like groceries.
That's true.
Rent is due.
Absolutely.
And I have this side hustle because I need that gap between my job that doesn't pay me what it should and I live in DC, for example, and it's ridiculously expensive, and so I've got to have this extra thing to bridge the gap.
Do you have clients who struggle with like that, especially when it comes tax time and knowing they have to pay quarterly? Do you have anybody who struggles with that?
I don't know if I'd say they struggle, but I'd say it's definitely a concern. Okay. Like it's like once it gets to the point where you need to hire a financial advisor like me, it's to the point where you're like, what's the most efficient way for me to pay this? Not necessarily where am I going to come up with the cash to pay this. Right. If that makes sense.
That makes sense.
So a lot of times the stuff we're talking about is more so like not making mistakes or making it the most efficient that it can possibly be.
Right. What do you say about, so for me, I've been doing my taxes since I was like 18 on my own, either through like paper filing or via some online service, right? And I felt a great deal of pride in doing my taxes for a long time. I don't feel that anymore. I just feel like burdened.
So you still do it yourself?
I still do it myself, and I'm at that point where I'm like, I'm ready to hand this to somebody else who does this on a regular basis, and at least for their side gig income. What have you heard just in your own life about the difference of hiring someone to do that element of the taxes, or maybe all the taxes, versus trying to figure out each and everything on your own?
So I, like you, used to do them myself. Stuff got a little bit more complicated, especially when you own property. Like that's when it really got complicated for me. But
you got the house in North Carolina.
So, but the challenge is if it can't fit on a 1040 EZ, which is like the one sheeter that you hear like politicians now talking about doing it on a postcard. Like if you can't do it on that one sheeter, you probably should be paying somebody else. Because what started to happen is filings that I had sent in like 2-3 years ago from doing it myself, I'd get a letter from the IRS saying we did an evaluation on it and you missed a step. So you owe us another $400 because you forgot to do X.
Yeah.
And so the TurboTaxes and whoever else of the world, not to pick on them specifically, but the folks that allow you to feel like, accomplished because you're doing it on your own,
Right.
you get what you pay for.
Absolutely.
So the difference between the $30, $40, $50 you spend on using software like TurboTax and hiring an accountant or a tax prep person or whatever you want to do,
Right.
A lot of times it's worth its money because the IRS isn't going away.
And to your point, just this past year, I got one of those letters in the mail that said, hey, on one end, on the business end, you owe this much for something that I didn't. And when tax people come, I'm like, here, take it. Take it. I don't want it. You take it from me now. Because I don't want them knocking at my door. But then I got another one from the state of Maryland, which said, like, we had, like, underpaid. And I'm like, wait a minute. I went through my online solution, and which means that y'all or the service missed something. So
and the service says in one of those boxes you click, we are just the conduit. We are
Right.
not responsible. At
Right.
the end of the day, you are the one signing and sending this thing in. So you are responsible. But as a business owner, as a person who has a side hustle, I recommend that people have constant contact and conversation with their accountant, with the person that prepares their taxes. I actually learn a good bit from my accountant.
Right.
So things to do throughout the year
Right.
to help, lessen the burden or help keep track of stuff. You learn that kind of stuff from having that conversation. So the fee that you pay, yes, it hurts a little bit to pay considerably more than you do to just pay TurboTax or whoever to do it yourself.
What's a
reasonable
reasonable price? Just if people are asking.
So it also is going to depend on the credentials that they have.
Right.
So the CPA, who is kind of like the holy grail as far as what you can get credential wise,
Right.
somebody to be preparing your taxes for an individual, you're probably going to pay something like $500 to file state and
Federal.
local and federal.
Right.
State, local, and federal. And then someone in between who's maybe like an EA, an enrolled agent, you might be paying like $350 instead.
Okay.
And then down to like your person
Certified
at the H&R
tax.
Block
Right.
or the whoever that took a course online and then now they're here in the Walmart. That person might charge you like $100. So it really just depends on how sophisticated you're wanting to go and the credentials and stuff.
My man is over here laughing at Malcolm.
Dude, these
This
are
is like
facts.
silent jokes just out of nowhere. Well, we want to remind people you're listening and watching Manage Your Damn Money with Ben and Malcolm. We're going to take a quick music break here and a piece by our in-house producer and co-creator of this show, Mr. Beats by Beeman. You can find his music on Instagram at Beats by Beeman, spelled B-E-M-E-E-N, Beeman.
Tore that one all up.
Yeah.
B-E-E-M-E-N.
Just try it a bunch of different ways till you find it. And then, of course, if you have questions or you want us to cover a particular topic on the show, send us an email, info@manageyourdamnmoney.com. Also, you can find us across all the podcast platforms, Apple Podcasts, SoundCloud, Stitcher, and Google Play. Simply search Manage Your Damn Money with Ben and Malcolm, and we will come up. Hit subscribe. Leave us a review. Tell us how great of a job we're doing. Leave the poor comments to yourself. Give us 5 stars. That helps us go up in the ratings. This is Manage Your Damn Money with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm. Today's conversation at hand, the history of taxes in America and abroad. If you've been watching the news, you know American politicians are pursuing a restructuring of the American tax code. Who pays too much? Who pays too little? Do the wealthy business owners take tax savings and reinvest in businesses to create jobs, or do they keep the extra cash for themselves? These questions and more are all baked into the circuitous debate around taxes in America. And given it's the end of the year, we at NYDM thought we'd take a look back at the history of taxes in America, how they've been structured, and how taxes came to be. Malcolm, so are you aware of where taxes came from, just like without us having prepared for this show? Do you think that you could answer the question, where did taxes come from?
Broadly. I believe history says that it came from, in this country. I don't know where it came from in general.
Okay.
But as far as the United States is concerned, it came from folks needing to fund wars. Mm-hmm. And so they taxed the wealthiest citizens initially to fund those wars. Right. And then the wealthy citizens one day up and realized, if we just hire people to rewrite the tax code for us in our advantage, then we no longer will have to pay those taxes. It'll fall to the poorer citizens who initially decided we should be the ones to pay the taxes.
That's not what's happening today. No, I'm playing. Anyways.
Well, history tends to repeat itself.
Indeed it does. Well, Tax History Chronology by taxworld.org. Taxes actually, at least according to where we looked up, started or originated somewhere in Egypt, maybe. During various reigns of Egyptian pharaohs, tax collectors were known as scribes. During one period, scribes imposed a tax on cooking oil. So to ensure that citizens were not avoiding the cooking oil tax, scribes would audit households to ensure that appropriate amounts of cooking oil were consumed and that citizens were not using leavings generated not using something generated by other cooking processes as a substitute for taxed oil. So they were making sure you were using oil, or a certain kind of oil, and then making sure you weren't using a substitute for it. Then if we move on to Greece, in times of war, as Malcolm said, the Athenians imposed a tax referred to as the isphora. I'm saying that with a Spanish accent. I don't know why. No one was exempt from the tax, which was used to pay for special wartime expenditures. And then it goes on to the Roman Empire, and this is kind of like in chronological order. The Roman Empire, the earliest taxes in Rome were customs duties on imports and exports called portoria, or maybe portoria. Again, my California coming out, portoria. During the time of Julius Caesar, a 1% sales tax was imposed, and during the time of Caesar Augustus, the sales tax was 4% for slaves, so for the poor people, and 1% for everything else. Oh, so you had to pay a tax of 4% on slaves and 1% for everything else. Then we're getting closer to what we're familiar with, Malcolm, colonial America. And I kind of like, when I was reading this stuff, I was flashing back to sitting in my history classes, bored. But colonial America, colonialists were paying taxes under the Molasses Act, which was modified in 1764 to include import duties on foreign molasses, sugar, wine, and other commodities. The new act is known as the Sugar Act. Because the Sugar Act did not raise substantial revenue amounts, the Stamp Act was added in 1765. The Stamp Act imposed a direct tax on newspapers printed in the colonies and most commercial and legal documents. It's interesting because I remember like the Boston Tea Party and things like that, like those painting pictures that were in your history book of people tripping over taxes.
Right.
Do you remember that?
Some. I didn't really pay too much attention in history class, to be honest. Like, it was like,
Who could blame you, especially as a high school kid? History was like extremely not important to me then. But it's important to me now because it helps you understand why things are the way they are. But after several false starts in imposing a citizen-wide tax, the Tax Act of 1862 was passed and signed by President Lincoln on July 1st, 1862. The rates were 3% on income above $600 and 5% on income above $10,000. So that was like the introduction of like a graduated tax structure.
So that Tax Act of 1862 is about where I was starting.
Okay.
So that essentially, where you were talking about folks who made $10,000 a year in 1862, is about the equivalent of what we're arguing about people who make like $2 million, $3 million, $5 million a year.
Right.
So that was essentially a tax on the wealthy,
right?
Not the majority.
Right. Absolutely. The rent or rental value of your home could be deducted from your income in determining your tax liability. So again, there comes like the first kind of introduction of what would be a deduction. And then the Commissioner of Revenue stated, the people of this country have accepted it with cheerfulness to meet a temporary exigency, and it has excited no serious complaint in its administration. This acceptance was primarily due to the need for revenue to finance the Civil War. And then in 1864, tax rates for the Tax Act of 1864 were 5% for income between 600 and 5,000. Then 7.5% for income between $5,000 and $10,000, and 10% on income above $10,000. So again, now we're seeing a greater stratification of the tax system and the tax structure. The deduction for rent or rental value was limited to $200. A deduction for repairs was allowed. So now, like, here comes introduced in 1864, initial complications of the tax code, right? And then in 1913, the 16th Amendment was passed, which allowed Congress authority to tax citizenry on income on whatever source derived. It said, quote unquote, or says, quote unquote, the Congress shall have power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states and without regard to any census or enumeration. And that, of course, is the 16th Amendment, which essentially said the American government or Uncle Sam can come get his piece.
Well, not only that, though, it says we're no longer going to only tax the wealthiest 1 or 2%.
Right.
We're coming for all of y'all.
Absolutely.
We've run out of people to tax. They're figuring out loopholes to get out of it.
Right.
So now we've got to come back around and come get you, the people who voted it in to be in the first place,
Right.
who thought it sounded like a great idea because it didn't affect you personally.
Right. Absolutely. So, Malcolm, we see the history of taxes. Like you said, war was often a reason for the institution of taxes on citizens. Taxes also derive from the fact that government does not usually engage in any profit-making activity.
Mm-hmm.
So the only way it can derive income to fund itself is by taxation of its citizens. But this thing clearly has always been hotly debated just throughout history in terms of who needs to pay and why. So it's interesting because, like you mentioned, the debate that is happening now currently and that we have every so many years in American politics specifically always seems to be kind of the same, and kind of you can trace it back even further back in American history.
You know what's really interesting? You kind of touched on it very quickly and moved on, but what's the most interesting thing to me is that the tax situation, the income situation, is probably the thing, or one of the, maybe let's say, top 3 things that makes people determine which party affiliation they align themselves with. And so the reason that we know that to be a fact is because as you have conversations with people socially, they align with one party for a very, significant portion of their life.
Right.
And then depending on how their income changes, all of a sudden they realign themselves with a completely different group. And so, for example, I'm going to use Bill Gates.
Okay.
So Bill Gates initially called himself a self-proclaimed Democrat.
Okay.
So initially, Bill Gates doesn't have a whole lot of money, but he comes from a family that's kind of well off.
Right.
But he himself, having gone to college in a liberal place like Harvard, decided, I'm going to be a Democrat.
Right.
Then he starts to make a lot of money, becomes a capitalist, and says, you know what? I no longer identify with those people who want to tax every single dollar I make.
Right.
I plan to take over the world.
Right.
I now consider myself to be a Republican.
Right.
Then he actually did take over the world, started to make more money than anybody ever dreamed would be possible by one human, not named like Rockefeller or something. And all of a sudden decides, you know what, I've made so much money, I'm never going to get a chance to spend it. I want to start giving it away because I'm never going to get a chance to spend it in my lifetime. Why not do some good?
Right.
All of a sudden has now aligned himself once again with the Democratic Party, saying, I feel that the folks at the very top should pay more in taxes, kind of like that whole Warren Buffett thing.
Right.
So it always aligns properly with where you are in your own income bracket, if you will. And that's what a lot of times people use to determine their own political affiliation. Forget all the other 99 points that party might stand for. I don't want to pay more in taxes, so I'm going to vote for these people.
Absolutely, absolutely. Economics are always at the heart of many decisions made. We want to remind folks you're listening and watching Manage Your Damn Money with Ben and Malcolm. Today's conversation at hand, the history of taxes in America and abroad. We're going to take another quick music break, but before we do, we want to remind folks, if you're an artist or musician of some kind and you want to have your music played during one of our shows, just send us an email, info@manageyourdamnmoney.com. We'd love to hear a snippet of what you got, and if it's good, we'll run it right here on the show. You can also find us, Manage Your Damn Money, on Facebook, facebook.com/manageyourdamnmoney, or on our website, www.manageyourdamnmoney.com. We're going to take a quick music break, hear another piece by Beats by Beeman. We will be right back.
I love you. listen. Now listen.
Welcome back to Manage Your Damn Money with Ben and Malcolm. We were just kind of carrying on the conversation from on the other side of the break. It's interesting because I felt this myself personally. Not that anything's deep changed, but when you start getting taxed at a much higher level, your perspective can change, especially when it comes to taxes, because more money is literally being taken out of what you feel yourself to have earned. Like
Right,
you get a whole check for $20,000 for whatever reason, right? 35% of that isn't yours. So
well, it is
temporarily, but the government needs its piece, and so in that way, you're like, well, you're missing a nice big chunk of $20,000 that can go towards things that you need or want to do. And yet the government needs their piece, and that might change your perspective.
But it's just interesting how like the people who you, let's say, went to college with, who were like the most bleeding heart, liberal, left-leaning Democrat, you know, banging the table, we got to support Obama,
right?
Person you ever met, all of a sudden when they get out there in the work world and they start making six figures and creep up into a new tax bracket and are staring down the barrel of another one, all of a sudden they start sounding real Republican. So it's just, you know, it's interesting how that one thing is enough to make someone completely change their party affiliation.
That's really funny. Of course, we're talking about the history of taxes in America and abroad. And to kind of bring it up to current day times and a little bit of what we were just talking about, the New York Times released an article by Alicia Parlapiano. I got that one. And the headline read, 6 charts that will help explain the Republican tax plan. And it outlined changes being proposed by House Republicans, at least at the start of November. It's since progressed a little bit. But the bill, according to this New York Times piece, would reduce the current marginal income tax brackets to 4 from 7. So that's like reducing those slots that you can fall into. There would be a 12% bracket, a 25% bracket, a 35% bracket, and a 39.6% bracket, and lower taxes by increasing income ranges affected by each rate. The top rate would be the same as it is now, except the income level at which it would apply would only increase to $1 million for married couples from 48,000. Excuse me, 48. What? What is this, Malcolm?
480,000.
Thank you. 480,000 under the current law. Thank you, sir. Brain fart. While the lowest income rate would increase, typical families in the existing 10% bracket would most likely be better off because of a larger child tax credit and an increase in the standard deduction. The full effects of the plan on different groups has not yet been fully analyzed by experts. It would repeal the estate tax after 6 years. In the meantime, doubling the amount of the inherited wealth that is exempt from the tax to $11 million from $5.5 million. The plan would nearly double the amount of the standard deduction and eliminate the personal exemption, a deduction based on the number of taxpayers and dependents claimed on the return. People would be mad about that. And then the story went on to get a little bit more detailed. But some interesting highlights from that. Again, reducing the tax brackets from 7 to 4. I think that was kind of like the main takeaway.
I'm all for that simplification, though.
You've been talking about that for a while. You've mentioned that before on the show before.
Like, well, not only that, like I was surprised at how many people were actually interested when I was like tweeting about the new tax code. And folks are actually like responding to me on
about
Twitter
taxes.
about the new proposed tax code. I was like pleasantly surprised that there's like more nerds out there besides myself. But anyway, so I mean, it helps because expanding who gets to qualify for which bracket, for one thing, simplifies the tax code for the do-it-yourselfers like you.
Right.
So I'm less likely to make a mistake if I already know which bracket I'm going to fall into. But another thing, really quickly, a lot of times people tend to focus a little bit too much on which bracket they fall into, because we do actually have what's called a progressive tax code here in the United States, which means the first portion of your income that hits a certain trigger, you pay that lower tax rate. So say 12%, 15%, whatever it is. The income up to what qualifies for the 15% tax bracket, you're going to pay that amount.
Right.
Then as you hit the next bracket, you're going to pay the difference between that 15% bracket and, let's say, 25. And then you hit 28, and you're going to pay the difference between that 25% bracket and that 28.
Right.
And so your effective tax rate is the thing you ought to be most concerned with, because that's the one that's actually like been blended down to capture all of the different trigger points along the way.
Right.
So, you know, it's a little bit of a misnomer that when you say I'm in the 25 or the 28 or the 39.6% tax bracket, that you're actually paying that tax rate on all of the money that you made through the year.
Right.
I know that's a lot easier for me to say being on this side of 39.6 than actually having to pay it.
Right.
However, it is important, like I said, just to keep in mind that because we have a progressive tax system, you're not shouldering the entire almost 40%, even though, like, you know, for some people paying 20 is too much.
Right. And speaking of that progressive tax bracket, those progressive tax brackets, excuse me, for single folks, and I'm gonna read off how our system is currently structured. The 10% rate in the United States starts at $0 to $9,300 a year. So that's only 10% of your money is getting taxed when you make that much, which is, you know, a nominal amount. Then the 15% for single people happens at $9,300 to $3,700 essentially. Then 25% happens at $37,000 to $91,000. And then it starts getting kind of granular after that. 28% is $91,000 to $191,000 essentially. And then 33% happens at $191,000 to $416,000, and then 35% effective tax rate hits when you go from $416,000 to $418,000. So that's a really small window. There's a very few people who are getting taxed at the 35% rate. And then after the top one that you said, 39.6 as currently constructed, if you're making $418,000 a year or more, give or take a few dollars, you're getting taxed at 39.6%, which is a huge number. And then real quick, if you're filing married, which can help, you know, in America, I think they kind of make it, you know, taxes are benefit. There's a benefit for being married. 10% is $0 to $18,000. 15% is $18,000 to $75,000. 25% is $75,000 to $153,000. Then 28% is $153,000 to $233,000. Then 33% is $23,000 to $416,000. And then another small window at 35%, $416,000 to $470,000. And then 39.6% for married couples hits at $470,000 or more, which is actually pretty close to the single. So there's not a huge difference there. So it's interesting. What can you glean, Malcolm, from what our tax system says about our values as a country? Like, have you ever thought about that?
Not really.
Is that a real deep, esoteric question of mine?
I don't know what you can really glean from taxes other than we believe in taxing the citizens for the things that the government does.
Right.
Without getting too specific, you know, I personally am more of a fan of the government having what's called a sovereign wealth fund, where basically they're managing a portfolio the same way individuals do. And the government owns assets and makes money off of their own investments so that the citizens pay less.
Okay.
But that's a totally different conversation for a different show.
Absolutely.
But anyway, so I think, you know, my issue isn't necessarily paying taxes. I completely understand that as a citizen of this country, it is a requirement of most of us, maybe not at the highest level, but of most of us, that we pay taxes.
Right.
I am okay with that as a concept. My issue is what the government does with the taxes once I pay them. So the fact that, you know, I look around and I see programs that the government is funding that are completely against what I actually believe in as a citizen. Then I look at it and go, well, what am I paying these taxes for if you guys are misappropriating these funds? If you're spending them on stupidity, now I have a problem. Like, for example, where we saw a few weeks ago, maybe it's been a couple of months now, the labor secretary's wife get in trouble for posting on Instagram that they took Air Force One or a U.S. jet to go on their honeymoon.
Right.
So you're using tax dollars, $25,000 or whatever they said it cost to fly to that location. The Health and Human Services Secretary, who was forced who was shamed into stepping down, Tom Price, who racked up like $450,000 in expenses on using private jets to fly around the country to conduct government business, instead of flying,
That would qualify as foolishness.
Right. So that's my tax dollars at work, technically.
Right.
That's where I have a problem with paying taxes. It's not necessarily the programs that are to help the people with less.
Right.
It's the fact that tax dollars a lot of times get reallocated to help people who don't need the help in the first place.
Absolutely.
That's where I have a problem with our tax code here.
Interesting. Well, we're going to take another quick music break here, another piece from Beats by B-Men. We want to remind people you can always catch us on our website, www.manageyourdamnmoney.com. If you have a question, concern, or suggestion, we'll answer it here on the show. If it is a question, send it to us, info@manageyourdamnmoney.com. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm. We want to remind people you can always find us on social media as well. What's your handle, Malcolm?
At Malcolm on Money.
And I am at MYDM with a 1 at the end. Today's conversation at hand, we're talking about taxes and the history of taxes in America and abroad. So it's interesting because what's true about taxes, and I think this is kind of my own personal fascination with this topic, is that there's no one way to tax a populace.
Right.
And there's no one way, as you mentioned or alluded to, there's no one way for government to earn income, be it through a fund that they manage for profit or via taxing their populace in different ways. And I read this book from the library. I don't remember the actual title, but it was a book about the quote-unquote fair tax. And the fair tax book that I read about was the first time that I ever personally had my awareness brought to the fact that there's different ways to tax a populace, right?
Sure.
So we'll talk about what the fair tax is. We pulled a story which had the 7 innovative tax reform proposals from Kiplinger.com. It was a slideshow by Joy Taylor in 2011 and looked at 7 different types of alternative tax systems. And I pulled a couple just to kind of talk about and kind of run through. First, there was the flat tax. This proposal calls for a single flat rate tax on income for all taxpayers. So rather than those like 10%, 15%, 28% things, it would just be one flat rate and everybody pays some amount of their income for that. Wages, retirement, plan distributions, and unemployment compensation would be taxed at 17 or 19%, somewhere in there, in the first 2 years. And then Social Security, interest, dividends, and capital gains would be tax exempt. So no taxes on Social Security income, interest, or dividends earned through capital gains efforts. And
That's already dangerous.
Right. And then also backers of the flat tax cite its simplicity, a single low rate on income, and very few deductions. Filing could be as easy as you said, Malcolm, filling out a postcard. But it doesn't sound like it would. That's a whole lot of money that won't be taxed if you're taking out, especially dividends and capital gains.
Right, because the wealthiest people make the most amount of money on their investments in the stock market.
Right.
So or
in
real estate, on assets in general.
Yeah.
So if you're not taxing any of the income that I make on my investments,
Right.
I'm just going to continue to pile as much money as I possibly can into the stock market,
Right.
get rich that way,
Right.
and not have actively earned income like, from working for an employer or what have you.
Right.
So then essentially the folks who are the most financially savvy
Right.
and are the most financially sound, right? They're on pretty solid footing,
Right.
are going to end up paying far less
Right.
than the people who actually do every day get up and work 2-3 jobs.
Right.
And realistically, the person who makes $50,000 is going to feel that 17% tax a lot more than the person who makes $5 million
Right.
and pays that same 17% tax.
Right.
So it just, you miss a lot.
Right. And I think too, the other thing that I'm interested and fascinated by is the fact that, like, there's no one right way to do it. And this way, yeah, you give everyone a fair, like, tax bracket or the same tax bracket, but it's still, like you said, missing out on revenues for the government or even being actually fair at its core.
Yeah, the fair is the part that's misleading.
Right, absolutely. Then there's also so that was the flat tax, and now it's the fair tax. This is a 29.9% sales tax collected only at the retail level, which would be imposed on sales of goods and services. So retailers would collect the tax and pass it on to the government. The tax wouldn't apply to assets purchased for business or investment use, and tax rebates would be provided, including a stipend for each family equal to 23% of the federal poverty level. Proponents tout the simplicity of the plan. Critics say it's regressive and the rate is too low to generate enough income for federal revenues. And the fair tax this was the thing that I read a book about. Essentially, it says anything that you buy that's new, there's a certain, like, extra tax on top of it, and that tax goes towards the government.
But I only pay taxes when I spend money.
But you only pay taxes.
I can get with that.
You like
so
that?
I mean, you're incentivizing me to be cheap.
Yes, indeed.
Like, you're incentivizing me to not spend a dime that I don't absolutely have to.
Right.
Which kind of gets at the core of a problem the United States already has embedded in our DNA, which is that folks just don't save.
Right.
So if now I only pay taxes when I go to spend money at the register, but now I'm incentivized to keep my money to myself, I can get behind that one.
Absolutely, absolutely. Then there's also the value-added tax, which is also known as the VAT tax. The value-added tax is a consumption tax similar to the national sales tax. However, instead of taxes imposed once at the retail level, a smaller rate of taxes imposed each time a product or services is sold or a value is added. So the tax, take the example, of a manufactured goods. A tax is applied when the manufacturer sells the goods to a wholesaler, and again when the wholesaler passes them on to the retailer. That's an interesting model, but the one that I think people complain about because the same thing is being taxed multiple times at different points, at different checkpoints, which for a lot of people wouldn't make sense and would probably make things more expensive for the end user. So, like, think of someone selling a hat in bulk, it's taxed there. Then that store person who's selling the hats has to, put them on the rack. Then they have to account for that first tax they paid, and then also whatever tax at their level that they have to pay, which, is debatable whether or not that's something we would want to add. Then, of course, there's another one, adding a national sales tax. Some tax reform proponents favor retaining the income-based tax system and supplementing it with a consumption tax, similar to the approach used by many other industrialized countries. This could be tempting to tax risers as it means a raising of additional revenue to reduce the deficit. And then a little bit of a pivot here. According to the Organization for Economic Cooperation and Development, the U.S. is one of the lowest tax countries in the world. The average effective tax rate for the U.S. is 26%, which is actually kind of low. And the average across developed nations is 34%.
That's tough to get out there, though. That message is a tough message to get out there when you have a president who's constantly telling people that we're paying the highest tax rate of any other country in the world.
Right.
And we pay way more in taxes than China, and Mexico's coming over here and producing goods and stealing jobs and blah, blah, blah. So a lot of times it's hard to really get at the meat of who's paying what, and find out where you actually fall in that entire thing. And you also have, like, this argument over whether corporations, if they were to get to pay lower taxes, would actually reinvest any of that into the greater, society, and if that would be something that trickles down to the rest of us. So you you get a lot of like misnomers that are thrown out there from folks in government,
Right.
Where hopefully folks, listening to this show will at least be remotely interested in paying attention to the argument right now that's being had on Capitol Hill about redesigning the tax code, because it does affect us in more ways than we probably realize.
Absolutely.
And if you are a person who listens to sound bites and goes, oh, well, we do pay way more taxes than we should. Our corporations do pay more taxes than they should. And if those people got to pay less in taxes, then my wages would go up.
Right.
I doubt it.
Right, absolutely.
So,
and a little perspective, too. We said we have the United States has a pretty low effective rate across the developed world. Taxes in the United Kingdom, this is the breakdown. 20% for $32,000, or excuse me, pounds. So that's like the lowest level, 20% for up to 32,000 pounds. And then 40% for 32,000 and 150,000. So that's 40% for that gap. The next gap is 45% for 150,000 pounds and above. Interesting thing, I went to London with my wife and parents-in-law a little while ago, a year or two ago, and they have incredibly high taxes there. Like, you're almost incentivized not to make money in the UK. But the other part of that is they can walk into a place and get free health care. They also get like free college.
Mm-hmm.
So the government is able to fund more like comprehensive, good for everybody type programs. In a way.
So Bernie Sanders should move there and leave us alone.
Yes, the Bernie Sanders model, so to speak. And it's interesting because we went to Paris. And there was this couple, this very good-looking, well-put-together couple, and when the bill came, one was a banker, the other one was a nurse. Mm-hmm. And when the bill came, their car didn't work. So I was like, well, dang, them taxes must have got all his green, so he couldn't pay for dinner that night.
Oh, my God.
I was legitimately thinking about that at dinner, watching this couple not being able to pay.
So you go on vacation to judge strangers.
Exactly. Well, by this point, we had gotten to know them.
Okay.
And it was kind of like we got quiet when this was happening. It was like, oh, let's mind our business.
Oh, my God.
But anyway, in the Netherlands is actually the country with the highest national income tax rate. And their tax rate, Malcolm, is 52%, which is ridiculous. And then in terms of those in the top tax bracket spectrum in terms of countries is France, Belgium, Finland, and Italy. They're at the top. And at the bottom, the people paying the least is Mexico, Chile, Korea, the United States, and Switzerland. So to your point, we're on the bottom end of the spectrum, and that's, of course, according to the Organization for Economic Cooperation and Development. So what does this tell us about taxes and how they're viewed across the world, Malcolm?
I mean, it tells us that they're not going anywhere, I guess is the way to look at it. Like the fact that all of these quote-unquote developed nations have their own version of how their citizens pay taxes to support their government tells us that, you could move away from here, but you're still going to have to pay some kind of taxes as long as you're earning an income, right? So, it's just one of those things that whoever has the better idea, like I am all for reforming the tax code from the way it is right now. Mm-hmm. But the challenge to that is everybody who can afford to add an iteration to look out for their own interest will do so. And so when you hear things about like private interests in the tax code, there are specific lines in the tax code that are written for like Lockheed Martin. Or Boeing or Apple or Amazon. Like they literally are called like the Amazon tax. Right. So as long as things like that exist and everybody's not technically paying their fair share, like really we're just having an argument that has 6 in one hand and half a dozen in the other. Like it's
right. And that's one of the reasons why I called it a circuitous debate, is because we just have it over and over and over again. Well, we hope this was a good refresher and primer for tax season for those who are starting to get their minds wrapped around that. We hope this was helpful. We want to remind people you can always find us and listen to past episodes of Manage Your Damn Money on Apple Podcasts. Simply search Manage Your Damn Money. Same on SoundCloud, soundcloud.com/Manage Your Damn Money, as well as Google Play and Stitcher. You can always find us on our website, manageyourdamnmoney.com. And if you have questions, suggestions, or want to send some music in to have played during the show, send it to us, info@manageyourdamnmoney.com. Malcolm, what is your social media handle?
At Malcolm on Money.
And of course, mine is at MYDM1, and those are both on Twitter and the gram. This is Manage Your Damn Money with Ben and Malcolm. Until next time, be good with your money.
Peace.
Peace.